we raise the share capital? There are several options, and if it's not yet listed in the stock exchange, for example, we talked about Safaricom. For the longest time, it was not listed. Then around the 2005 or 2006, they issued a prospectus and an initial public offering was done. And this is for companies not yet listed, companies that are not trading. Currently, Safaricom cannot issue an initial public offering. Neither can KCB, neither can that Vipingo, EABL. These companies are trading already. So they're not allowed to go back again and issue that IPO in order to raise share capital. So the IPO has an opening price set for its shares when they are released onto the market. And how much financing can be raised, it depends on the perceived value. How does the public view this company? Does the public associate it with progress? Does the public associate it with growth? So it's not set that every company that issues an IPO, it will be successful. The public may shy away if they feel this company may not do well, either because of bad publicity or they have issues attached to it. But if the company believes that there is hope and the market is favorable for the company, then the amount of financing raised by issuing an IPO may be huge. Also, the company needs to read the mood of the economy in order to ascertain, will you be interested in buying shares, or what is your interest currently? A company has no control of an IPO because it's let out to the public. They will decide, we want to trade with this company, we don't want to trade with this company. And the reasons given behind may not be rational, because as human beings, our actions are not only guided by a prospectus may be issued, and it shows the financials, it shows the audited reports, and on paper, everything looks set to make good money. But because of our biases and how we react to things, that element of herd mentality, and we say no. This company, the director did ABCD. We are not sure if even in this one, the company will collapse. So that is for a company that wants to trade and was not listed. But for a company that is already listed, we have talked of EABL, East African Breweries, Rare Vipingo, KCB, Equity. They use a seasoned equity offering or a rights issue. This is CEO or a rights issue, and it's a new equity issue by a company that follows its initial public offering. And a rights issue permits existing shareholders to purchase a designated number of new shares from the company at a specified price within a specified time. And the company, let's say for instance, KCB in prior years had issued a rights issue. So the existing shareholders are told that we have new shares that we are floating. You will be given the opportunity, like the first priority, to purchase them at a special price for the existing shareholders. But it will not be forever before they are released to the market. So you're given a specified time, is done by the resolutions, and you as a shareholder, you are allowed to exercise this right. Again, it's not a must. It is never a must. It's an optional thing. If you don't want to exercise that rights issue, the rest of them are floated to the public, and again, you can buy from that angle, or a completely new shareholder is able to buy that. And the offer may be accepted or rejected. And when you accept them, they are normally transferable. You can accept, then sell them. There's no problem with that. These additional shares are normally on a pro rata basis. That is, 2 for 5 rights issued, whereby you're offered 2 shares for every 5 you already have. This is to give you, the existing shareholder, a chance to add that you can dispose of any other time. So for a seasoned equity offering, the company determines how many more new shares will be floated, will be issued, and at what price, and how the current value will affect new and existing stockholders. So what are the advantages of raising capital by issues? So for a company, we have talked about the IPO. For a company that has a fairly strong reputation and a certain size, and it's out there raising a large sum of money. But remember, we said this is a case-by-case study. It will not always work like that. The biggest advantage of raising share capital, either with an IPO or a seasoned equity offering, is the fact that it's not a loan. You need not repay this, but you'll agree to distribute future profits in return for the investments. You see, at no given time are you told, return this money because probably you've amassed this wealth. It's not a loan. You did not borrow this money from the shareholders. They offered to buy and you offered to sell. So you will be able to use the amount raised to build your company, to continue with your operation. I tell them that if we trade, what are the disadvantages? Is that the company's owners, you see, when you do an IPO and everything is out in the public, your finances are out in the public, your audit reports out in the public, you no longer have full control of the business, and you become accountable to these stockholders. And you remember, we talked about how this business is transacted. If you want to do something, you'll need to call for an AGM. If probably you want to change a company from limited by guarantee to limited by shares, again, special resolution, that may be blocked. So the essence of you having full control is no longer viable. You have control in as far as the shareholders will allow you. They can remove you from office as a director. They can make changes that suits them. And this is because you've given them that, they have given you their money. So in exchange for that, they have taken a part of that company. So how do we issue a company's authorized share capital? So there's placing, whereby a company, instead of selling its shares directly to the public, it will engage with a broker to sell them on their behalf. So for placing, you have the company, gives to a broker, the broker sells shares to the public. So what we mean is that the shares are said to be placed with the broker. And where it's for selected customers, it's private. Rather than making them available to the whole public, you simply place them to the broker. The broker then will issue to the rest of the public. We also have an offer for sale, whereby a company sells some of its shares to a financial institution called a house issuing house, which will then resell the shares to the public. And this, you will get a document called an offer for sale. So this one, the company will issue a renounceable announcement letter to the issuing house to facilitate the transfer of specific shares to designated purchasers. So again, the offer for sale, for the offer for sale, you have that there's the company. The company gives sells shares. And you remember the allotment letter. Yesterday we talked about allotment letters. In this instance, they're giving those ones they can renounce for those that will not be given to designated issuing house, which then resells the shares. The public. This is for specific people that you will need, and the difference between the first one of placing the shares to the broker, they're offered for sale to selected customers. The offer for sale method is where you get an institution, and this is for protecting the company. You see, an IPO, you have limited to zero control. But in these two, you're able to influence the outcome. You see, you know how a broker works. A broker will sell to you. They will make it more attractive. They will entice the public to buy. Offer for sale, that institution again will be given the mandate. The company will step aside from the day-to-day of ensuring that the shares sales are successful. You give the job, you sell them to the issuing house and give them that job. Make sure that you sell out these shares. And the last one is where a prospectus is issued. So they are sold directly to the public. There are no intermediaries.